The Psychology of Money, written by Morgan Housel. In this video, we summarized 8 lessons from the book that seeks to explain the way money works in the real world. Introduction. Why should I care? Learn the psychology behind how money is spent and saved. What happens on the stock market? When should you buy or sell assets? And how much do you need to save each year to retire by a certain age? These are the kinds of questions that come up most often when talking about money. But something important is often left out of the equation. This is the human factor, or the relationship between real people and their money. Morgan Housel says that this is the most important thing to know about how money decisions are made. If you want to know why people go into debt or waste money, you don't need to study interest rates. Instead, you need to look into the history of envy, greed, and optimism, which is all too human. And that's exactly what we'll do in the next part of this summary. You'll also learn along the way how personal experiences affect investment strategies, why finding one Picasso could mean buying 99 duds, and how envy makes investors risk everything they already have. First, everyone has their own experiences with money and the economy. Everyone knows what happened during the Great Depression. After the stock market crash of 1929, which was very bad, the world economy went into a decade of steady decline. The Roaring Twenties ended quickly in the United States. Businesses went out of business, families lost their farms and homes, and people's hard-earned savings were gone. Poverty and unemployment went through the roof, and people lost hope that tomorrow would be better than today. Today, this is the most common story about what happened. That makes sense, since it does describe what millions of Americans go through. But it also leaves out something very important. The main point of this summary is that everyone's experiences with the economy and money are different. In 1960, when John F. Kennedy ran for president, he was asked about the Great Depression. Many voters were surprised by what he said. He said that the Kennedys were already rich in 1929. And their wealth didn't go away over the next 10 years, it actually grew. By 1939, the family had more servants and a bigger house than when the decade began. When he went to Harvard and read about the Depression, he realized how bad things were for a lot of people back home. It turned out that not every American was in the same boat. Kennedy wanted to change that, which is part of how he persuaded voters that he wasn't just an out-of-touch elite but a good choice for president. But the rich and the poor aren't the only ones who have different experiences with money. We all do. Not only do the son of an unemployed farmhand and the son of a successful stockbroker in Manhattan come from different backgrounds, but they also learn very different lessons about money, like the difference between risk and reward. But, as we'll see later, the same is true for people with the same amount of money but different life experiences. For example, a rich person who grew up during times of high inflation will have a different view of money than a rich person who has only ever seen prices stay the same. What we do with money is shaped by the lessons we learn from these different points of view. We all like to think we know how the world works, but most of the time, we only see a small part of how it really is. And this is the first thing you need to know about the psychology of money: we don't know as much as we think we do. Main point 2: Personal experience drives financial decision making. When economists try to model how money works, they often use a convenient lie, that people are rational and make decisions that are best for themselves and give them the most money. The world isn't quite as neat as this idea, of course. Take the lottery as an example. In the United States, the average low-income family spends $411 on lottery tickets every year. At the same time, about 40% of all households have trouble coming up with $400 when they need it. Not surprisingly, this 40% is made up of the same low-income households that spend just over $400 on lottery tickets. Is this a good way to act? Hardly. But it doesn't make no sense either. If you don't have enough money to buy the things you need, let alone go on vacations, you're probably living paycheck to paycheck. It's a long shot to play the lottery, but it's better than not having any chance of getting the good things that rich people take for granted. The main point of this summary is that people make financial decisions based on their own experiences. More people make these kinds of crazy calls than you might think. This is what economists Ulrike Malmendier and Stefan Nagel found in a study they did in 2006. They looked at data from the Survey of Consumer Finances, a long-running research project that looks at what Americans do with their money. This project has been collecting data for 50 years. Malmendier and Nagel wanted to find out why people invest their money the way they do. Their reply? When the investors were young adults, how the economy was doing. In other words, how we feel about risk depends on our own past. This isn't the kind of logic you find in economics books, like buying lottery tickets, but it makes sense. For example, If inflation was high when an investor was in their late teens or early 20s, they were very unlikely to buy bonds later in life. If, on the other hand, inflation was low during these formative years, investors were happy to keep putting their money into bonds even as inflation rose. A similar pattern holds for stocks. When people were young adults, if the stock market was doing well, they invested in it. If it wasn't doing well, they stayed away from it. You were born in the year 1970. Between the time you were in your late teens and early 20s, the S&P 500 went up by 10 times. Whoever put money into companies that were listed in that stock did very well. People who were born in 1950 had a very different experience with the market, which was mostly still during this time. The most important thing is that people's decisions about whether or not to invest didn't change even when the market itself changed. This suggests that real-world evidence didn't change people's early life gut decisions. The economic ideas we use today are still very young in terms of history. A toy poodle doesn't look much like its wild ancestors, who didn't look much different from wolves. This shouldn't come as a surprise because dogs have been tamed and trained for 10,000 years. Even so, dog owners are often surprised by their pets' natural, bloodthirsty reactions when they see a cat or a squirrel. It turns out that these deeply rooted wild traits haven't gone away completely in 10,000 years. But what does the fact that dogs were tamed have to do with how people think about money? Quite a bit, to be honest. The main point of this summary is that the economic ideas we use now are still very young in terms of history. Why can't so many of us handle money well? One answer is that it's still pretty new in the big picture. Around 600 BC, when King Elias of Lydia, an Iron Age kingdom in what is now Turkey, made his own coins, the first money was created. And that's not even hard compared to other economic ideas. Take retirement. Most Americans worked until they died before the Second World War. Even though people lived shorter lives back then, half of all men over 65 were still working in the 1940s. After World War II, when Social Security was created, things started to change, but most American workers didn't think they could ever retire until the 1980s. That's when the average monthly Social Security check, adjusted for inflation, went over $1,000. Before that, only a small number of wealthy people could afford to stop working in their mid-60s. That means that one of the most important economic ideas we use today is less than 200 years old. The most popular way to save for retirement, the 401k, didn't even come out until 1978, and the Roth IRA wasn't created until 1998. Other important ideas and habits aren't that much older. Only in the last 25 years have hedge funds really taken off, and index funds are only 50 years old. Even mortgages, car loans, and credit cards, which are a big part of what makes the US economy grow, didn't become common until 1944, when the GI Bill made it easier for average Americans to borrow money. If we're not good at planning and making decisions about money, it's not because we're crazy, because we're just starting out. Main point 4. Luck has a bigger impact on how much money you make than you might think. A few years ago, the author asked Robert Shiller, an economist who had won the Nobel Prize, what he would like to know about investing that he couldn't fully know. Shiller's answer was the exact role that luck plays in good outcomes. Luck is hard to talk about. Few investors and entrepreneurs would deny that it plays a role in theory, but it's hard to quantify the extent to which it's responsible for one firm prospering and another failing. We also think it's rude to say that someone else's success was just luck. So, when it comes to making financial decisions, we often don't take luck into account. That is wrong. Here's the main point: luck matters more than you might think when it comes to money. Economist Bhaskar Mazumdar says that the income of two siblings is a better predictor of how similar they are than either their height or weight. If your brother is rich and tall, it is more likely that you will be rich than that you will be tall. It's easy to explain how this link works. Siblings who live in the same home are likely to have the same rights and chances. When parents send one child to a good school, they usually send the other child to the same school. Find a pair of rich brothers, though, and you'll find two people who don't believe that Mazumdar's study applies to their family. That has to do with how people think. Most of the time, we either don't give luck enough credit or give it too much credit. If we do well, it's because we worked hard. If we don't, it's because we were unlucky. But if other people fail, we aren't nearly as kind. In those situations, failure isn't due to bad luck, but to character flaws like being lazy or not being able to see the big picture. Our culture, which is very focused on success, isn't much help here, though. Forbes doesn't write about smart investors who lost everything because they were unlucky and the market dropped quickly. It does, however, praise bad or risky investors who were lucky and made a lot of money. That puts us in a tough spot. When it comes to money, we need to figure out not only what works and what doesn't, but also how to add randomness to our models. Schiller's dream of figuring out the exact role of chance might not come true, but as we'll see, we can get a handle on luck. Key idea 5. You can make better decisions if you look at broad patterns instead of individual cases. Bill Gates once said that success doesn't teach you much. Gates thinks that success makes smart people forget how important luck is, which makes them think they can't lose. In a strange way, that's a pretty sure way to make sure you lose. So how should you work chance and luck into how you handle your money? Well, here's what you shouldn't do. Focus too much on specific people as examples. When we study people who have been very successful, we tend to focus on the billionaires who have changed the way the world works. This can lead us astray. The main point of this summary is that you can make better decisions if you look for broad patterns instead of specific cases. Take one of the most successful businessmen in history, John D. Rockefeller. When he began building his oil business, he ran into a problem. What he wanted to do was against the law in the United States. His answer was easy: just ignore them. One judge said that his business was no better than a common thief because it didn't follow the rules of the law. The way we think about this behavior is changed by how successful Rockefeller was. Looking back, it's easy to praise his vision and say that he didn't let old laws stop him from coming up with new ideas. But what would happen if he failed? Would we still think that we should follow Rockefeller's lead? Most likely not. At best, we'd think of him as a bad guy who didn't get away with it and showed us what not to do. But when it comes down to it, luck is what makes the difference between these two results. Rockefeller's life could have been different if he had gotten different verdicts here and there, or if the political climate had changed. Even more important, it's almost impossible to copy good luck. Even if you try to copy everything that Warren Buffett did in his career, you can't be sure that the dice will roll the same way for you as they did for him. So, here's what you can do instead: keep looking at patterns of success and failure. The more common a pattern is, the more likely it is that you can use it to make decisions about your life and money. For example, study after study shows that people who are in charge of how their days go are happier at work than those who aren't. Unlike the few extreme cases, this is a general observation you can act on right away. 6th, envy can make you act in a dangerous way. Capitalism is great at two things: making people rich and making people want to be rich. Take a baseball player who is just starting out and makes $500,000 a year. He is rich by any reasonable measure. But if he plays on the same team as a superstar like Mike Trout, who makes $36 million a year, he might not be happy with what he makes. He wants to be like everyone else. On the other hand, people like Trout who make a lot of money compare themselves to those who make even more. In 2018, for example, you had to make at least $340 million to be one of the top 10 highest paid hedge fund managers in the United States. Even Trout would be a small fry by that measure. In terms of capitalism, there is nothing morally wrong with being envious. But there is a problem in the real world. The main point of this summary is that envy can make you act in a dangerous way. How much is enough? Just ask Rajat Gupta. Gupta was born in a slum in Kolkata, India. He worked his way up to become the CEO of the management consulting firm McKinsey. He was worth $100 million when he retired in 2007. He was free to do anything. But Gupta wanted what he had. He wanted to have a lot of money. In 2008, Gupta, who was on the board of directors at Goldman Sachs, found out that Warren Buffett was going to put $5 billion into the company to keep it going through the financial crisis. Gupta called a hedge fund manager 16 seconds after hearing this news on a conference call, long before it was made public. He bought 175,000 shares of Goldman Sachs. It is illegal to trade on inside information. Gupta didn't care. He had just made $1 million quickly and easily. By the time prosecutors caught up with him, he had made a series of bad deals that netted him $17 million. He wasn't a billionaire because of it, but it was enough to get him a long time in prison. What does this story teach us? When you make bad decisions because of envy, the cost is much higher than the benefits. Think about it this way: if you have an insatiable hunger, you'll eat until you're sick. But getting sick is much worse than having a good meal, so don't do that. Leaving opportunities on the table doesn't always mean you're missing out. Often, it's a sign that you know trying to take advantage of everything will make you regret it. So, don't be like Rajat Gupta. 7th idea. It's easier to make a lot of money than to keep it. In the early 1900s, Jesse Livermore was one of the best stock traders in the United States. He was born in 1877 and worked on building Wall Street. He was worth $100 million in today's money by the time he was 30. Just before the crash of 1929, Livermore made the best decision of his career. He took a short position and bet that stock prices would go down. The market did indeed lose 1/3 of its value. While investors lost their fortunes and news spread that some of them jumped out of office windows, Livermore went home to tell his family good news. He had just made about $3 billion in today's money. Happy ever after? Not quite. The main point of this summary is that it is easier to get rich than to keep it. Don't forget what we said about how success is a bad teacher? Well, Livermore thought he couldn't lose after his big win in 1929. He bet more and more, and each time he lost big, he bet more. This went on until all of his money was gone. In 1940, he killed himself in a Manhattan club because he was broke and owed a lot of money. It turns out that sometimes it's a lot easier to get rich than to stay rich. People who are good at the first tend to have trouble with the second. Getting money is all about taking risks, being hopeful, and being brave. Keeping money is a completely different game of mind. It's about being afraid of losing everything you've worked for. To stay rich, you also have to be humble. After 1929, Livermore started to think he was a genius who could do no wrong. He would have done better to realize that luck had played a role and that he couldn't keep having the same success over and over. There are a lot of people like Livermore, but their stories usually aren't as sad. About 40% of all companies that are on the stock market lose all of their value over time. And the Forbes 400 list of the richest people in America changes by 20% every 10 years, not counting deaths and transfers within the same family. So how do you keep what you have? In short, it's persistence. The best business owners stay in business for a long time without giving up. Fear is the one thing that they all have in common. Michael Moritz, who has made a lot of money in venture capital, says that when you're afraid of losing, you look at possible wins in a different way. Few gains are big enough to be worth putting everything you already have at risk for. When you look at things this way, you are much more likely to make better decisions. Main point 8. Even if you're wrong half the time, you can still make a lot of money. Heinz Berggren says that when he was young, he didn't show much promise. He didn't know what to do with his life when he was forced to leave Nazi Germany in 1936. After going to the University of California, Berkeley to study literature, he worked as a journalist and did art criticism on the side. In 1940, he paid $100 for a small painting by an artist named Paul Klee. It was the start of a lifelong interest in contemporary art. In the 1990s, Berggren was one of the most successful art collectors who had ever lived. In 2000, he sold his collection for €100 million to the German government. It had a lot of Picassos, Klees, Matisses, and Braques, so that wasn't even close to what it was really worth, which was estimated to be $1 billion. The collection was one of the most important in the world. The main point of this summary is that even if you're wrong half the time, you can still make a lot of money. How did Berggren get this impressive collection of works by the best artists of the 20th century? Was it skill or just luck? Horizon Research, an investment firm, has a more interesting answer. The company's research shows that all of the best collectors do the same thing: they buy a lot of art. Some things a collector buys end up being great investments, especially if they keep them for a long time. But most of them don't work. Horizon's report says that the trick is to keep the first ones until the portfolio return, or the value of the whole group, converges on the return of the best elements in the portfolio. Berggren's portfolio was similar to an index fund in that his risks were spread out over a wide range of investments. He didn't just buy pieces he liked or admired, instead, he bought everything he could and waited until a few winners stood out. This plan works for any investment. It's called the long tail because a small number of events tend to account for most of the outcomes. This idea is based on a lot of complicated math, but when you get down to the basics, it's easy to understand. When you do a few things well, you can get away with doing more things wrong. Failure is inevitable. What matters most is how well you do when you do succeed. When you're sitting on a Picasso, you don't have to worry about the other 99 pieces in your collection that aren't as good. In conclusion, the main point of this summary: making financial decisions in the real world is a lot messier than it is in economics books. Many choices, like buying lottery tickets when you don't have any money, aren't logical, but they make sense in their own way. The same is true for investment decisions, which are often based on what people learned about the economy when they were young adults rather than on a cool assessment of how the market is doing now. Simply put, psychological factors play a role in financial decisions. So what's the best thing to do? Well, accept that luck plays a part in success, learn to be afraid of losing what you already have, and spread your bets. We're glad you watched. If you want to buy a copy of the book, you can click on the link in the description box and go to Amazon. Please don't forget to subscribe, like, and share this with your friends and family.